Welcome, everyone. Today, we are diving deep into something that might feel a bit intimidating at first, but I promise it will make a lot more sense by the end. We are going to learn how to read stock market graphs in a way that is easy and approachable, even if you are just starting out. By the end of this, you will be able to look at a stock market graph and understand what it is telling you without feeling overwhelmed. Imagine having a map that shows you not only where a stock has been, but also hints at where it might be headed. That is exactly what a stock market graph can do for you. These graphs are like your guide to making smart moves, helping you decide the right moments to buy or sell. Stick with me and I will break down all those lines and numbers so they become crystal clear. Trust me, once you learn how to read these graphs, you will see how powerful this knowledge can be for your trading and investing journey. So, what is a stock market graph exactly, and why should you care about it? A stock market graph is a visual representation of a stock's price movement over time. Imagine looking at a chart that goes up and down, showing you exactly how much the stock was worth at different points. It is like watching the entire journey of a stock's value play out before your eyes. These graphs are essential because they help you understand if the stock is gaining or losing value. Not only that, but they also reveal patterns and trends that can guide your investment decisions. There are different types of stock market graphs, each with its own purpose. The line chart, for example, is the most straightforward kind. It shows the closing price of a stock for each day, with all the points connected by a simple line. It is great for seeing the overall direction of a stock, whether it has been going up, down, or staying relatively stable. If you just want a quick snapshot of the stock's general trend, a line chart is your best friend. Next up is the bar chart, which is a bit more detailed. Each bar tells you a lot more information than a simple line. It shows the opening and closing prices, as well as the highest and lowest points a stock reached on a given day. If you want to understand the stock's behavior during each day, like when it peaked and when it dipped, the bar chart is a fantastic tool for that. It gives a fuller picture of the stock's daily activity. Then there is the candlestick chart, which many people find incredibly helpful once they get the hang of it. A candlestick chart has individual candles that are either green or red. A green candle means the stock price went up during that time period, while a red candle means it went down. Candlestick charts are fantastic for giving a quick visual summary of how a stock is performing and for seeing price changes at a glance. They pack a lot of information in an easy-to-understand way, making them a favorite among traders. Each of these graphs serves a different purpose, and together they give you a complete view of what is happening with a stock. Whether you want to get a quick overview or dive deeper into the day-to-day movements, there is a graph that can help you do just that. These tools might look complex at first, but once you know how to read them, they become an incredibly powerful way to make smarter investment decisions. You might be thinking, why does this even matter? Well, if you know how to read these graphs, you will be able to see if a stock is on its way up or starting to fall. This is the kind of information that can help you make smart decisions about when to buy or sell a stock. Are you ready to take the guesswork out of investing? Let us keep going and explore the different types of graphs you will see. There are a few different types of stock market graphs, and each one tells its own story. First, we have the line chart. This is the simplest type of graph, and it is a great place to start. It shows the closing price of a stock over time, and all the prices are connected by a line. It is a quick and easy way to see if a stock has been moving up or down in general. If you just want to see the big picture, this is the chart for you. The line chart is perfect when you are looking for a straightforward answer to the question, is the stock trending up, down, or staying flat over time? It provides a simple, no-frills look at the overall direction, which can be incredibly useful for beginners who are trying to get comfortable with how stocks behave. But why does this matter? Because understanding even a basic trend can help you decide whether or not to invest. If you can clearly see that a stock has been steadily moving up, you might decide that it is a good time to jump in. If it is consistently moving down, you might want to think twice or at least do more research before buying. This is why line charts are often the first step in making smart investment choices. Next, we have the bar chart. This type of graph shows more information than the line chart. Each bar shows the opening and closing prices for a specific day, along with the highest and lowest points the stock reached during that time. If you want to get a closer look at how a stock is behaving each day, this is the graph you would look at. It gives you a deeper view of the stock's daily movements. The bar chart helps you answer more detailed questions, like what happened during the day that caused the price to peak or dip. This extra detail is valuable because it lets you see the daily highs and lows, giving you insight into the volatility and behavior of the stock. Knowing when a stock tends to peak or bottom out during the day can be very helpful if you are planning to buy or sell at the right moment. Finally, we have the candlestick chart. Now, do not let the name scare you off. A candlestick chart is similar to a bar chart, but it is easier to read once you get the hang of it. It has candles that are either green or red. If a candle is green, the stock's price went up that day. If it is red, the price went down. This makes it easy to see at a glance whether the stock was rising or falling. Many people like candlestick charts because they give you a lot of information in a simple, visual way. The candlestick chart shows the opening and closing prices along with the highs and lows, just like a bar chart, but it adds more visual cues. The colors make it very easy to see patterns in buying and selling pressure. For instance, a long green candle might indicate strong buying interest, while a long red candle could signal a lot of selling pressure. These visual cues are helpful because they make it easier to spot trends and market sentiment. Understanding the different types of stock market graphs helps you choose the right tool for the type of analysis you want to do. If you want to see the big picture, the line chart is your go-to. If you want to get a more detailed view of each day's movements, the bar chart is great for that. And if you want to get a feel for the overall buying and selling pressure and see it all in an easy-to-read format, then the candlestick chart is the one for you. Each of these graphs has its strengths, and using them together gives you a fuller understanding of what is happening with a stock. Once you understand what these charts are telling you, you will start to see why they matter so much in making informed, confident decisions about where and when to invest. Then there is the bar chart. This type of graph shows more information than the line chart. Each bar shows the opening and closing prices for a specific day, along with the highest and lowest points the stock reached during that time. If you want to get a closer look at how a stock is behaving each day, this is the graph you would look at. It gives you a deeper view of the stock's daily movements. Finally, we have the candlestick chart. Now, do not let the name scare you off. A candlestick chart is similar to a bar chart, but it is easier to read once you get the hang of it. It has candles that are either green or red. If a candle is green, the stock's price went up that day. If it is red, the price went down. This makes it easy to see at a glance whether the stock was rising or falling. Many people like candlestick charts because they give you a lot of information in a simple, visual way. Now that we have talked about the different kinds of stock charts, let us move on to the important parts you will see on every stock graph. First, you will notice the price axis. This is usually on the right side, and it shows the stock's price. It gives you an idea of the highest and lowest prices the stock has reached during the time you are looking at. There is also the time axis, which runs along the bottom. This shows you how long of a period the graph is covering. It might be days, weeks, or even years. The longer the time frame, the better you can see the big picture of how the stock is doing. One more thing you will often see is volume bars below the main graph. These bars show how many shares were traded during a certain time. If there are big volume bars, it means a lot of people were buying or selling that stock. If there are small bars, there was not much trading activity. Understanding volume is important because it shows how much interest there is in a stock. Many people like to draw lines called trend lines on their graphs. A trend line shows the overall direction the stock is moving. If it is sloping up, it means the stock's value is generally increasing. If it is sloping down, the stock is losing value. Trend lines can make it easier to see what is happening with a stock without getting lost in all the small daily movements. So now that you know what the graph looks like, how do you actually use it to make decisions? One of the first things you should do is look for the trend. Is the stock moving up, down, or sideways? If it is moving up, that is a good sign that the stock is gaining value, which means it could be a solid investment opportunity. If it is moving down, it means the stock is losing value, and you might want to avoid buying it or consider selling if you already own it. If the stock is moving sideways, it is not making big moves in either direction, which could indicate that it is stable but not currently providing big gains. You can also use these graphs to determine when to buy or sell based on patterns that repeat over time. For instance, if you see a stock consistently rising after reaching a certain point called support, it could be a good time to buy when it approaches that level again. Conversely, if it struggles to rise past a certain price called resistance, you might consider selling before it hits that peak again. Recognizing these patterns can make a huge difference in your success as an investor. Another powerful way to use these graphs is by identifying changes in momentum. A stock that has been trending upward but starts showing smaller gains or even a few down days could be losing momentum. This might be a signal to hold off on buying more or even to sell before the stock loses more value. On the other hand, a stock that has been falling but starts to stabilize and show small gains could be gaining momentum, which might mean it is time to consider buying in. Lastly, graphs can help you manage risk by showing you how volatile a stock is. If you see large swings up and down, that means the stock is volatile, which could offer high rewards but also high risk. If the price movements are smaller and more predictable, the stock may be less risky, making it a safer investment for those who are more conservative. The key is understanding what kind of investor you are and using the graph to match the risk level that fits your style. Next, pay attention to something called support and resistance levels. Support is the level where the stock seems to stop falling and starts going back up. Resistance is the level where the stock seems to stop rising. These levels are important because they can give you clues about what the stock might do next. If a stock is getting close to its support level, it could be a good time to buy. If it is near resistance, it might be time to sell. Another thing to think about is volatility. Volatility is how much the stock price is swinging up and down. If a stock has big swings, it is called volatile. That means it is risky, but could also mean big rewards. If a stock has smaller, more predictable movements, it is less risky but may not have huge gains. Knowing how much a stock moves can help you decide if it is right for you. The time frame is another important thing to think about. If you are a short-term trader, you will want to look at charts that show daily or weekly movements. These charts are great for showing small changes in the price and can help you decide when to buy or sell quickly. If you are more interested in holding a stock for a few months, a 1-month or 6-month graph is useful. It shows how the stock has been doing over a medium time. If you are thinking long-term, you will want to look at graphs that show 1 year or more. These graphs give you the big picture and help you decide if the stock is growing over time. Now, let us talk about indicators. Indicators are tools that can help you understand even more about a stock's graph, giving you valuable insights into market trends and helping you make informed decisions. One popular indicator is called the moving average. The moving average helps smooth out all the ups and downs by showing you the average price over a specific period of time. This makes it easier to see the trend without getting distracted by the daily changes and can help you determine whether the stock is in an upward or downward trend overall. Another useful tool is the relative strength index or relative strength index. This indicator tells you if a stock is overbought or oversold. When the relative strength index is high, above 70, it means the stock might be overbought and a drop could be coming soon. When it is low, below 30, it could mean the stock is oversold and might be ready to bounce back up. The relative strength index is helpful for finding buying or selling opportunities based on the stock's recent performance. Bollinger Bands are another great indicator. These bands consist of a moving average line with 2 bands above and below it, showing the upper and lower price levels. Bollinger Bands help you see if the stock is priced high or low compared to its recent history. When the price touches the upper band, it suggests the stock might be overbought, while touching the lower band might mean it is oversold. This can give you an idea of when a stock might change direction. Another interesting indicator is the moving average convergence divergence, or moving average convergence divergence. The moving average convergence divergence shows the relationship between 2 moving averages of a stock's price and helps you identify changes in momentum. It is made up of a fast moving average, a slow moving average, and a histogram that shows the difference between the two. When the fast moving average crosses above the slow moving average, it can be a sign that the stock is gaining strength, and when it crosses below, it can be a signal of weakness. We also have the stochastic oscillator, which is another powerful tool. The stochastic oscillator compares the current price of a stock to its range over a specific period of time. It moves between 0 and 100 and helps you identify overbought or oversold conditions. If the stochastic value is above 80, the stock could be overbought, and if it is below 20, the stock could be oversold. This indicator is particularly helpful in spotting reversal points, where the stock price might change direction. For those interested in trend following, the average directional index, or average directional index, is a useful tool. The average directional index helps you measure the strength of a trend. It does not tell you the direction, but instead tells you how strong the current trend is. A value above 25 generally indicates a strong trend, while a value below 20 suggests a weaker trend. This indicator helps you decide whether it is worth following the current movement or if the trend is losing steam. Another interesting and slightly more exotic indicator is the Ichimoku cloud, or Ichimoku Kinko Hayo. The Ichimoku cloud is a collection of lines that help you see support and resistance levels, momentum, and trend direction all at once. It might look complex, but it gives you a lot of information quickly, including whether a stock is likely to continue in its current direction or reverse. Traders often use the cloud to identify areas of support and resistance and to confirm the strength of a trend. Each of these indicators has a specific use, and combining them can give you a much clearer picture of what is happening with a stock. For example, you might use the moving average to see the general trend, the Bollinger Bands to spot potential overbought or oversold conditions, and the Relative Strength Index to confirm whether it is the right time to buy or sell. By using these tools together, you will be able to make more informed decisions and better understand the movements of a stock. Remember, the goal of using indicators is not to make things more complicated, but to help you see patterns and signals that might not be obvious just by looking at the graph alone. They are powerful allies in your investing toolkit, and with a little practice, they will become second nature to you. Let us put all of this together. The first thing you want to do when looking at a stock graph is choose the right time frame. If you are thinking about long-term investing, look at the longer charts. Then find the trend. Is the stock generally going up, down, or sideways? Next, look for support and resistance levels. These can help you decide when to buy or sell. Finally, use indicators like moving averages and the RSI to back up what you are seeing on the graph. Let us talk about some common mistakes people make when reading stock market graphs so you can avoid them. One mistake is overreacting to short-term movements. Stocks will go up and down every day, but the key is to focus on the overall trend. Another mistake is ignoring volume. If a stock price is moving, but there is not much volume, the move might not be very strong. Make sure you are watching how many shares are being traded to see if the movement is real. Lastly, do not get caught up in chasing trends. Just because a stock is going up quickly does not mean it is the right time to buy. You might end up buying right before the price drops. Use support and resistance levels to help you make a better decision. If you are just getting started, here are a few steps to help you practice reading stock charts. Start with simple charts like line charts so you can get used to how stocks move over time. Once you are comfortable, move on to bar and candlestick charts. Pick a few stocks you are interested in and follow their graphs every day. Notice when they go up or down and see if you can understand why. Practice with a simulated account to test your skills without risking real money. This is called paper trading, and it is a great way to build your confidence. Stock market graphs are your window into understanding price movements, and mastering how to read them can greatly enhance your ability to track a stock's performance. By examining trends, identifying support and resistance levels, and using indicators like moving averages and the Relative Strength Index, you can make more informed decisions. Begin with simple charts, build your skills daily, and soon you will find that reading these graphs becomes second nature. Remember, learning how to read stock market graphs takes time and patience. The more you practice, the better you will get. I encourage you to stay curious, keep practicing, and feel free to ask questions whenever something is unclear. Reading stock charts is a skill that will open up many opportunities, and you are well on your way to mastering it.